Want passive income without the hassle? Imagine getting paid just for owning a stock. No tenants, no side hustle, just real cash flow. It's called dividend investing, a strategy used by the wealthiest to build fortunes. You buy a piece of a company, and they send you a portion of their profits. Some companies pay dividends monthly, creating a portfolio that pays like a salary. This is how you make your money work for you. Here are 5 dividend-paying stocks and ETFs that send you monthly income, on autopilot. We'll break down what they are, why they pay, the risks, and how to start building your passive income machine. Let's dive in. First up, let's talk about Realty Income, ticker symbol O, which proudly calls itself the monthly dividend company registered trademark. This isn't just a catchy nickname, it's a reputation they've built over decades of consistent performance and reliability in the world of real estate investing. Realty Income has paid uninterrupted monthly dividends for over 54 years, making it one of the most dependable income stocks on the market. That's more than half a century of rewarding shareholders no matter what the economy is doing. As a real estate investment trust, or REIT, Realty Income owns and manages thousands of commercial properties across the United States and even internationally. Their tenants include well-known companies like Walgreens, FedEx, Dollar General, and many others, which means their rental income is backed by some of the most stable businesses around. The company's business model is simple but powerful. Collect rent from a diverse group of tenants and pass most of that income directly to shareholders. In fact, by law, REITs like Realty Income must pay out at least 90% of their taxable income as dividends, ensuring a steady stream of cash flow for investors. Typically, Realty Income's dividend yield hovers in the 4 to 6% range. While that might not sound sky high, it's a solid, reliable return, especially when you consider the company's focus on stability and long-term growth, rather than chasing risky, short-term gains. Of course, no investment is without risk. Realty Income's fortunes are tied to the health of the commercial real estate market and to interest rates. When rates rise, borrowing costs go up, and property values can fluctuate, which may impact the company's growth and profitability. But here's what sets Realty Income apart. They've weathered multiple recessions, market downturns, and economic crises, yet they've never missed a monthly dividend payment. That kind of track record is rare and speaks volumes about their resilience and management. Their secret? A highly diversified tenant list, spanning dozens of industries, and an experienced management team that knows how to navigate changing market conditions. This combination makes Realty Income a true blue-chip name in the REIT space, trusted by both individual and institutional investors. For beginners, Realty Income offers a straightforward, low-maintenance way to start earning monthly dividends. You don't need to be a real estate expert or spend hours researching tenants. The company does all the heavy lifting for you. All you have to do is buy the stock, and like clockwork, on the 15th of every month, you'll see a dividend deposit land in your brokerage account. It's a simple, almost hands-off way to start building passive income. Realty Income is a fantastic foundational holding for any income-focused portfolio. Its consistency and reliability make it a favorite among retirees, long-term investors, and anyone looking to add a steady income stream to their investments. By providing a stable base, Realty Income allows you to confidently build your portfolio with other investments, knowing you have a dependable source of monthly cash flow to support your financial goals. Next up is STAG Industrial, a company that's become a key player in the world of industrial real estate. Their ticker symbol is STAG, and they specialize in properties that support the backbone of the modern economy. STAG owns and operates massive warehouses and logistics centers. These are the facilities that make online shopping possible. As e-commerce continues to surge, the need for efficient storage and distribution grows, driving up demand for these spaces. STAG leases its properties to a wide range of tenants, from major retailers to logistics companies, creating a reliable and diversified income stream. Investors are drawn to STAG because it pays monthly dividends, typically yielding between 3.5% to 5%, a steady payout that appeals to income-focused portfolios. What sets STAG apart is its focus on secondary markets across the United States, where it can acquire high-quality industrial buildings at more attractive prices than in crowded urban centers. Of course, there are risks. STAG's business can be affected by economic slowdowns, rising interest rates, or shifts in tenant demand, which can impact property values and rental income. But the long-term trend of e-commerce growth acts as a powerful tailwind, supporting STAG's business model and helping to offset those risks. By investing in STAG, you're essentially owning a piece of the infrastructure that keeps the internet economy running: warehouses, distribution centers, and logistics hubs. Pairing STAG with Realty Income in your portfolio can offer valuable diversification, since you'll have exposure to both retail and industrial real estate sectors. This combination means you benefit from the stability of retail properties and the growth potential of logistics and warehousing. For investors seeking consistent monthly income and long-term growth, STAG Industrial is a compelling choice in the evolving world of real estate. Our third pick is Main Street Capital, ticker symbol MAIN, a BDC. They provide debt and equity financing to small and medium-sized businesses. Main pays a monthly dividend and often adds special dividends. The yield is higher, often in the 6 to 8% range. The risk involves investing in smaller private companies. However, Main Street has a strong track record and disciplined management. They are internally managed, aligning interests with shareholders. Investing in Main gives exposure to private American businesses. It's a growth-oriented income play with high monthly cash flow. If you're comfortable with higher risk for higher yield, Main is an excellent choice. It adds diversification beyond real estate. Just remember, BDCs are more sensitive to economic conditions. Now let's dive into the world of ETFs, starting with one of the most talked about income-focused funds, the JP Morgan Equity Premium Income ETF, or JEPI. This ETF has quickly gained popularity among investors who are searching for reliable, consistent income streams, especially in uncertain markets. JEPI is well known for its impressive monthly dividend yield, which often lands in the 7 to 10% range, much higher than what you'd find with most traditional dividend stocks or even many other ETFs. This high yield is a major draw for income-focused investors. The fund achieves this by holding a portfolio of high-quality, low-volatility stocks, and then selling covered call options on those holdings. This option strategy allows JEPI to generate extra income on top of the dividends from its stock positions. The result is a steady stream of income that's distributed to shareholders every single month, making it a favorite for those who want predictable cash flow. JEPI's high monthly cash flow is especially attractive for people approaching retirement, or anyone who needs regular income to cover living expenses, supplement a pension, or simply enjoy more financial flexibility. However, there's a trade-off. By focusing on generating high current income, JEPI sacrifices some long-term growth potential. The covered call strategy limits upside gains, so you won't see the same explosive growth as you might with a pure equity ETF. During strong bull markets, JEPI tends to underperform broad market indices like the S&P 500. But in flat or declining markets, its income strategy can really shine, providing stability and returns when others struggle. That makes JEPI a specialized tool, best suited for investors who want to supplement their income right now, rather than maximize long-term capital appreciation. In many ways, JEPI offers a bond-like stream of income, but with the added benefit of some equity upside, making it a unique hybrid in the investment world. It's important to understand that you're giving up some growth potential in exchange for that reliable monthly check, so make sure this fits your financial goals and risk tolerance. For those who prioritize income, JEPI has become a popular and effective option, often recommended by financial advisors and discussed in investment communities. Ultimately, JEPI provides a unique balance of income and stability, making it a compelling choice for investors who want to generate steady cash flow while maintaining some exposure to the stock market. Next is the ProShares S&P 500 Dividend Aristocrats ETF NOBL. It pays quarterly but is a masterclass in dividend quality and stability. Dividend Aristocrats have increased dividends for at least 25 years. NOBL holds these companies, offering diversification and reliability. The yield is modest, around 2%, focusing on dividend growth. Pair it with monthly payers for a balanced income portfolio. NOBL acts as the stable, growth-oriented core of your portfolio. It ensures your income stream grows over time, outpacing inflation. The risk is general market risk, but these companies are less volatile. NOBL is a quality control for your portfolio. It provides stability and growth, weathering any storm. It's a simple way to own reliable dividend-paying companies. Our final ETF is the Schwab US Dividend Equity ETF, SCHD. It pays quarterly but is foundational to a smart dividend strategy. SCHD screens for high yield, growth, and financial strength. It holds about 100 high-quality, high-yielding stocks. SCHD balances yield, growth, and quality, leading to strong performance. It offers a respectable yield and fantastic capital appreciation. Use SCHD as a core holding, combining it with monthly payers. The expense ratio is low, meaning more returns stay in your pocket. SCHD is a top contender for building a dividend portfolio. It's well-diversified, low-cost, and focuses on quality companies. It provides income and growth, anchoring any long-term plan. SCHD is the perfect engine for total return. How much do you need to invest to make $100/month in passive income? It comes down to the dividend yield. For $100/month, you need $1.200 year. With a 5% yield, you need $24,000. With an 8% yield, $15,000. Don't let these numbers discourage you. Start small and work towards your goal over time. Begin with your first share, even with $10. Consistency is key. Add monthly and reinvest dividends. Celebrate each milestone like your first dollar of dividend income. It's about building the habit and letting your income snowball. The journey starts with your first investment. Let time and compounding do the rest. The most powerful tool for building wealth is a DRIP, Dividend Reinvestment Plan. It automatically reinvests dividends into more shares. This unleashes the force of compounding. Reinvested dividends buy more shares, generating more dividends. Over time, this creates exponential growth. A DRIP turns your investment into a self-growing machine. Set it up once and your wealth builds while you sleep. Reinvesting dividends dramatically accelerates your financial progress. It's the secret weapon for serious wealth builders. Turn on the DRIP and let compounding do the heavy lifting. It's a simple step with massive long-term impact. Make sure the DRIP is activated for your investments. You've got the blueprint for generating monthly passive income. We've covered stable payers, e-commerce plays, high-yield BDCs, and core ETFs. Remember, passive income is a long game. It's about building consistent cash flow over time. Start small, add monthly, and reinvest. Let time and compounding work for you. Real wealth is built through discipline and consistency. Thank you for watching, and I'll see you in the next video.